On the podcast with us today is Kyle Jones. Kyle, welcome to the podcast.
Thanks, Dan. Thanks for having me.
Well, Kyle, I want you to get us started because I know we're going to be diving into this Pinewood Apartments property out of Chattanooga, Tennessee that you purchased, which was a 56-unit property. But I want you to talk a little bit about yourself and what you have done now in the multifamily space.
Yeah. So just to get right into it, I've been in the multifamily space for about 3 years now. Started smaller, buying a 14 unit, had a 21 unit under contract. It was like a marathon contract for like a year. That's a whole nother story in itself. And then slowly started getting into raising capital and partnering with other people who can just really ultimately help me scale the portfolio.
Well, and this particular one, I know we originally spoke when you were originally signed up to, be on the podcast with us, there was a different property we were going to talk about. And this is a different one that I think you are going to be talking about, which is the Pinewood Apartments, which is going to be a little bit more, a little bit more unique or whatever, and have a few more different, points to it. So I'm looking forward to diving into this one. So first off, let's get started and talk about how did you find Pinewood Apartments?
So, when I had made the decision to start looking for larger properties, I started reaching out to other brokers in different parts of the country and different markets that I had been looking at and identified from a standpoint of just having good economics behind it, job growth, population growth, all the things that you look for. So I flew into market and territory, met with the broker, saw some properties that I did the whole use LoopNet to target the brokers, fly in. I toured those LoopNet properties, and sure enough, they were dogs. But just my time there, I think it just showed some commitment for this broker that he knew I was serious. And so we were wrapping the day up in the late afternoon in his office and handed me a stack of offering memorandums and basically said, "Hey, we just did BVAs, business value assessment, or what is it? That's the corporate
BOVs.
BOV. Sorry,
broker opinion of value. Yep.
BVA. That's my corporate job coming out. But so basically, just had a stack of OMs that they had put together while doing the broker value opinion, and I looked through a lot of them. A lot of them weren't really what I was looking for, but a couple of them made sense and ended up moving forward on this one in Chattanooga. But it was essentially an off-market or pocket listing.
Well, that's probably the most real or true pocket listing that I've ever heard, which is I went down and flew at their office. We toured a bunch of properties. We sat down in the office, and all of a sudden he pulls out the BOVs that they're working on or just finished up and said, "Hey,
Exactly.
Want any of these?"
I mean, that was really it. And he and I kind of hit it off and just built some rapport together just through the day. But yeah, it was a pretty cool experience.
Yeah, that's pretty cool. I wish that was the way it worked all the time. That would be much easier. So on this particular one, you didn't have anybody else that you were competing with? It was just you?
Yeah, it was really just me. And I underwrote the property, and I took the approach of even doing a little video recording, because initially my underwriting was, I was being probably a little bit more conservative on the front end, knowing also that I was going to go out and raise capital too. But I had, during the negotiations with that seller, I had just did a little Zoom recording of me going through my analysis, and got some good feedback on that. And I think that kind of helped put me in a better position there.
Mm-hmm. At what point did you tour this property?
So I actually ended up touring that early in the due diligence phase. Okay. So I had already become somewhat familiar with the area, just talking to boots on the ground, property managers those types of people. So I was somewhat familiar with it, but I hadn't seen this specific property until just logistically, I couldn't get there until we were right under contract. It was during Christmas time, and I had a lot of other stuff going on.
Mm-hmm. So at what point did, as far as the asset class and the asset in the area of this property, what would you say the class of the property is and the class of the area?
So it's definitely a C class property, and probably a higher C market, like a C plus sub market. we knew that going in, but we also, just through conversations, and I'm really condensing the story here, but there was a lot of other conversations that took place. But one of the things that we found out during the due diligence phase was that the mischievous activity that was happening in that submarket a lot of it was stemming from this property. And so it was really isolated. So we kind of knew what we were getting into at that point. But the main thing that we knew that this was a good property was the fact of how severely under market the rents were. This is a 56 unit, all the bedrooms, all the units are 2 bedrooms, 1 bath, and average market rents for this property were at $500 to $525 in some cases. And there were a couple in the 4s. The going rate for this type of property that was just, renovated a little bit with just maybe a nice light package, fixture package, those were going for as high as $675. Literally across the street, 2 bedroom, 1 baths were going for $675. And I had actually toured those, and there was very, very minimal difference there. So that's why we knew we liked the deal. We felt comfortable with the deal, and with just the right property manager in place, we could probably mitigate a lot of the activity, and it really has since then. It's the business plan is holding true there.
So would you say it was a C- property and a C+ area?
Yeah, I think so. Just because there was also some deferred maintenance and just some things that needed to be cleaned up. And, it's amazing what a little bit of, water and soap can do to your property on the exterior and just really dress it up. So
what was the purchase price?
That was, I have to go back to my analysis. It was 1.675. So it was right under $30,000 a unit.
And what's your exit projections on the valuation?
So we projected out that it was about a 7. Our reversion cap we used was 7.5, and so what that equated to on the purchase price was about 3.1 over the course of 6 years.
So the whole period is 6 years?
Yeah.
And what was the entry cap on this one?
It was low to mid 6s.
Okay. What was the NOI on this one when you took it over? Not the projected.
The current NOI was about 110,000.
Okay. All right. And so you're trying to get it from the average 500 to 525, trying to get it to about 675, and then do that over a process and hold on to it for a few years, and then get into being able to exit at a 7.5. That's a pretty conservative exit cap, I think. For what's the market going for right now in Chattanooga?
Well, at the time that we put this property under contract, there was a property that was a little bit larger. It was closer to 100 units, but very similar, make and model, if you will. And it went for about 50 a door. Mm-hmm. And we purchased it at about 30, just with some of the deferred maintenance. We're pretty optimistic here. I mean, we're starting to see the business plan come to fruition. We were hit with some economic vacancy that we didn't anticipate, just because as soon as we took over, we found out there were a lot of tenants that were not paying rent. Mm-hmm. But behold, a lot of those tenants were the problem tenants that we were wanting to eventually remove anyways. Mm-hmm. So it just worked out. But we did get hit with a little bit of higher vacancy than we anticipated. And we had a property manager that wasn't, they weren't doing anything unethical. They just weren't moving quick enough with the unit turns. and we really needed somebody to be more engaged. One thing they did well, they evicted all of the problem tenants from what we can tell now. But it left us with we went from about 89% physical occupancy down to about 70, and then touched mid 60s. And now we're back up to closer to 80 when we made the change with the property manager.
So when you first took over the property, it was 89% physical occupancy. What was the economic occupancy?
I didn't go back and look at what it actually was, but based on the T12 and the rent roll, it was about 12%.
Okay, so it's pretty close in there as far as the economic occupancy. The economic occupancy wasn't 12%. That was the vacancy, probably.
That's correct.
Okay.
Correct.
I really hated if you had 89% physical and 12% economic. That'd be terrible.
Yeah.
So that's not bad. So when you first got into the property, did you see that there was a lot of past due balances or anything like that, or was it pretty well kept up?
The bills you said? Yeah, those were, they were pretty on top of paying their bills. It was really just more the tenants not paying the rent.
Yeah.
But the tenants that are still there today, they're still lower rents, but they pay on time. They like living there. I mean, they're probably never going to move just because of it. It'll probably cost a lot of money for them to move. But
now, when they come up for renewal, are you going to be basically telling them that you're going to either have to move and leave out when we're going to replace you with somebody with a higher rent, or are you allowing them to have smaller bumps until they get there over a few years?
We're starting to reassess that right now. I think the main thing is we want to create some stability with physical occupancy and kind of drive it up. The other thing too is we ended up taking a bridge loan on this, and so we would ideally like to refinance before our 12-month term, because it's basically a 2-year term on the bridge loan, but at the 12-month mark we have to pay another origination fee or a renewal fee, I guess, in that case. So we'd like to be able to refinance that, and so the Fannie and Freddie lenders want to see 90 for 90. So once we get to the 90% physical occupancy, then we'll start the refinance process and move forward with that. So
yeah, and we're going to dive into the financing a little bit deeper too, because I do have some more questions surrounding the bridge loan and the terms and rates and stuff like that. What were the projected returns on this one for investors?
So projected returns, let me go back to my analysis here because that was a while ago. So we actually, so one thing, the caveat to this is we really tried to break this model, but because the rents were so under market and it's a smaller unit count, the returns looked really good. I mean, when we initially went out to market, I'm looking at it now, is about 20% IRR over the course of 6 years, 12% cash on cash return.
What was your first year cash on cash?
First year cash on cash projection was, let's see, we had about 8%.
Okay. And then your sixth year?
Sixth year would have come out to, the 6 year we had about 17%.
Okay. No, those are pretty strong projections. I mean, pretty good. I think the biggest thing that helps you here is having so much disparity between what the existing rents are and what you can push them to, and having that market comp right across the street,
right,
and being able to do that. Let's talk about the property management real quick here too, because I know we touched on that a little bit. This is 56 units. So what kind of property management do you have there? Is there anything on site, or is all third party off site, or how's that working?
So we started when we first started, it was just all off site. We had a full-time maintenance person, and our maintenance guy, he's actually been the maintenance guy for over 7 years now, and really embraced us as new owners and could see that we wanted to really change the property. So. And he was a good worker, does good work, so we kept him. So really our payroll is just the maintenance person. And then in Chattanooga, we couldn't really find anybody else who would manage for a lower fee than 8%. And so they're managing offsite. Essentially, their office was right down the street anyways. So when we changed it, it actually worked out to our favor because the property managers that we're using now, they're actually based out of Nashville, which is about a 2-hour drive, but they do have other properties in Chattanooga, and their regional manager is now basically using our office. The previous owners had turned one of the units into an office because they had they did have a full-time leasing agent, but we just don't have the payroll for that right now. But by design and by some luck, our regional manager there is just using our office because their main office is in Nashville. Mm-hmm. So
who are you using?
It's called Volunteer Properties.
Volunteer.
Mm-hmm.
And the seller, how did they do their property management? Was it same way, kind of same setup, or did they actually have do their own property management?
They had third party. They were using a much larger company, nationally known type company that was based, I think they were based out of Atlanta, which is about 2-hour drive south from Chattanooga. And they just had an on-site leasing person. I think that was part of the issue, is why these rents were so under market, is because they really didn't have a presence there, the mm-hmm. local PM or the PM that was not local. Right. So we saw some opportunity in just the whole day-to-day operations too.
Yeah, for sure. So let's talk about when you put an offer on this thing, you purchased it for the 1.675. Was there, obviously you said there was nobody else competing against you. So was there any back and forth with the seller?
There was a little bit through the due diligence, because one of the things we didn't account for were the roofs that needed to be replaced. All the roofs. There's 7 buildings, all 7 roofs. And then there was also a completely down unit. Mm-hmm. It had apparently been burned out. And according to our maintenance guy, this happened like 3 years ago, and they just mm-hmm. left it. And even the broker didn't know about it. So it tells you that, the broker granted, I got to give him some leeway, because he was helping. He had just gone through the value assessment. And so it was still early in the process for the broker, and mm-hmm. he kind of cautioned me on that. But so there was some things that we came back with that said, hey, you didn't disclose this type thing. But at that point, they knew we were getting a good deal even as is. So they were pretty hard pressed. So we ended up getting like a $25,000 credit, which was still something, but it wasn't what we had initially asked for.
Mm-hmm. Did you have to put any earnest money up?
Yes.
And so that was the standard, like 1-2%, or what was the?
Yeah, I think it was a little more than 1%. It was closer to like 25, 30K.
Okay. And did that go hard after the 30 days due diligence?
Correct. Yeah. Okay. It wasn't hard earnest day one or anything like that.
Sure. And was it contingent upon financing?
It did. We were able to get a financing contingency as well.
Yeah. That's nice, because you can't always get that.
I have had, since that deal, we've closed on 5 other properties, and every single one of them, I've been able to get a financing contingency. So it's been,
just ask for it. The worst thing they can say is
I just put it in there. It's not like I draw attention to it. I just throw it in the contract.
Yeah. Well, it's always nice to have that extra cushion just in case. Yeah. If you can negotiate it in there, it's always great. So how did you structure? Well, first let's talk about this. Let's talk about the financing, since we kind of already brought that up a little bit. Sure. So you started with a bridge loan. Who's the bridge lender on this one?
It's a company called DLP. And they're out of the Northeast.
Okay. And did you go through a broker, I'm assuming?
We were using a broker for the bridge loan. I had actually created a relationship with these guys separately from the broker. So when we started using bridge debt, we just weren't getting the type of quotes that we were wanting. And so I had reached out to these guys, and they ended up, just because they had already known us and built some rapport with them, they were able to give us a little bit better terms. So I went with them. And
so they did a 12-month term with 1-year extension?
Yeah, it was basically, yeah. So basically 2-year term, but they charge a midpoint fee, like a 12-month
Okay.
fee.
And
Yeah.
what kind of interest rate did you get on this?
That was high eights. It was right under 9% interest only.
Okay. So it was right at 9%. And then the full term, 2 years IO?
Correct.
Okay.
Correct.
And the plan for this is to hold on to it and try to, in the first 12 months, to stabilize it for above 90% economic and physical occupancy so that you can go to Fannie or Freddie and do their small balance.
That's right. That's right. In fact, should be any minute now. We should be closing officially on a property we just used a small balance on. And one of the unique things that we did on this one that I hadn't used before is the hybrid program.
Mm-hmm.
It's only available for their small balance. Both Fannie and Freddie have this type of product, but I didn't know about it. Not a lot of people I've talked to heard about it, but it's essentially it is a true 20-year term on the loan. But 7 years, the first 7 years are fixed and the remaining 13 are adjustable. And so if you think about in the time that we're in now, where people are wondering where the market's going to go, you get to the end of that 7-year term, you're at least not going to have a balloon payment that will force you to sell the property or take a loss or give it back. So, it de-risks the situation a little bit on the back end if you just want to bite the bullet and you've hopefully created enough cash flow and value to handle a higher interest rate at that point. But you've got another 13 years to figure it out, kind of thing, if we're in a down market. So I really like that product. It was very competitive to just the standard, fixed term and be done with it. So,
what are some of the rates that you're seeing on that product?
So we finished, we locked that at 5.3.
Okay. That's not bad. It's not bad. Especially for that full 7-year initial term.
Yeah.
And how much IO are you getting on that?
2 years.
2 years.
Yeah.
Okay. Still not that bad. Not bad at all. How much CapEx did you have in this project?
So we had we ended up at about $350K.
Okay. And what did that go towards?
It was mostly unit turns. So, so the specific things
Interiors.
Interiors, so specifically floors. We're putting the vinyl flooring, fresh coat of paint, of course, resurfacing countertops as needed, although we really haven't had to do that yet in any of our turns. And then just the brush nickel fixture package. So there's still some brass in there and, just a hodgepodge of just fixtures. So just doing a solid fixture package and dressing it up a little bit.
Are you doing any are you having to do any HVAC replacements or, appliance package or anything like that?
Some of them do need new appliances. For the most part, HVAC has been okay. We did the roofs. I mentioned that on the exterior.
So does that $350K include the roofs?
It does.
Okay.
It does.
Okay.
Yeah.
And so what's your projected time frame to turn these 56 units and to be able to, upgrade them and push the rents higher than to where you really want them at that 675?
So we were able to kind of test it out because we got hit with a higher vacancy. So we're averaging about 4 to 5 turns a month. And, I think, I don't even think I mentioned this. So we were projecting 675. Our new property manager, as we're bringing in new tenants, they're already putting people in at 675. We were projecting to be at 675 at year 4 in our model.
Wow.
And we're getting that now. So, we like where we're at. And our property manager's been doing a phenomenal job of just really kind of pushing the market a little bit. But they're doing a really good job of bringing the units to par with market and what's across the street, especially.
So how did you structure the deal with investors?
So it's interesting. We actually had a 1031 investor who was just going to do the whole capital raise initially. And then they things got a little hairy at the end of the financing because we were initially going with Freddie, and then they came back and cut loan proceeds big time, which is why we ended up going with a bridge loan. Anyways, but in that process, the 1031 just kind of, decided to go do their own thing, which actually in the long run, it was better for us anyways. So we raised capital pretty quickly. We structured it 80-20, just straight equity, 80 to investors, 20% to the general partners, with a 1.5% asset management fee each month.
And what was the acquisition percentage on this one?
Acquisition
fee?
Oh, it was, let me go back. We did 3% on this one.
Okay, that's pretty standard. And on the 80-20, was there any hurdles in there, like any prefs or anything like that?
No, we just did straight equity. And that's typically how I structured all my deals at this point. It just really simplifies it. A lot of our investors aren't really familiar. I mean, they are familiar with real estate, but when you start talking about prefs and hurdles and things like that, it's just like a foreign language to them. And so we just stick with the straight equity.
Sure. And did you have any other fees outside of the asset management and acquisition, like any disposition, refinance, or anything like that?
We didn't on this one. We kept the fees low. It was a smaller deal. We wanted to just really get a lot of interest too. The other thing too, so in that, from the time the 1031 individual left to the time we closed, we had to raise, we raised like $750,000 in a couple of weeks. So
that was really my next question, is how much did you have to raise?
It was a really short time frame. So we just wanted to make it as clean as possible, get a lot of interest. We knew we had the deal. We knew the returns were there, but we wanted to just eliminate any other kind of fees, miscellaneous fees. Just do, what we're doing is pretty bare bones compared to what you see a lot today.
Mm-hmm. How many investors did you end up having?
I think it was around 7 or 8, if I remember correctly.
Okay. And this was done via syndication, PPM, all that kind of stuff?
We did. So we had to move fast. So if you kind of picked up on that, it all happened in about a 2 weeks time frame. So not only was our bridge lender able to close in that time frame, but our attorney was able to basically overnight a new PPM and change it out, because it still had the 1031 language in there. So we just kind of scrapped it and started over, and then do a webinar all within a couple of days and get interest. So it was very stressful, mainly because I put up all the risk capital as well. So I was not sleeping during that 2 weeks, but it was fun.
Where did you find your investors?
Just a network, mainly through my other partners. So I had brought a couple of investors that I had kind of been cultivating, but this was the first syndication that I had actually done and raised money on. Like I mentioned earlier in the podcast, I had only just self-funded our deals. My wife and I, we buy our own deals and do it that way. So through telling a few people, I had brought my own investors, but that's the power of partnerships. I was able to leverage our team and leverage their network to raise the capital.
Mm-hmm. And kind of going back to some of the due diligence process, because I know we kind of skipped over some of that. Sure. Was there anything in the due diligence that came up that I know you mentioned the roofs and stuff like that? Was there anything else that came up during due diligence that maybe kind of stood out to you?
One thing that was unique in this area is they had clay pipes. A lot of the older buildings have clay pipes underground. And so it could potentially cause a lot of problems. So it made us really look at it. We did not account for capital. We were thinking through it as a team. Hey, do we need to ask the seller to this? But it's like, hey, he's not going to give us any kind of concession because it's not an issue for him, So what we ended up doing to kind of protect ourselves is we added that to our insurance policy. We just had some language in there around the sewer lines and the clay pipes. And so we were able to provide ourselves with some protection through our insurance policy rather than just raising more capital to change all those out down the line. We still have our reserves. If we needed to act quickly, we can do that, but we'll essentially, be able to take a claim out and go through that process if we ever have to encounter something like that. But that was really the only thing that stood out other than what we've already talked about. So it's fairly straightforward beyond the roofs and that burned out unit.
What do you like the most about this asset?
I just really like the potential there. And we're starting to kind of hit our stride there. And I really think, if it were up to me, it's a property that, we just refinance it and hold it forever, just because I really like the Chattanooga market overall. And you can just see the excitement with some of the existing tenants who have been there a while. They can see us investing capital in there. And so there's kind of this buzz around the property, according to our maintenance staff and our property manager, that people are really getting excited. We're about to go ahead and change the name so that we can kind of start fresh from like the reviews online and things like that. And but we're not just doing that to just try to cover up anything. We're really trying to make the changes and start at the foundational layer with hiring a property manager, just really bringing in the right tenant profile, making sure that these people can pay, that they're paying on time. And if they don't, it's a really short leash.
Mm-hmm. Yeah. And what do you like the worst about this property? Meaning, like, where do you feel like there is the most risk with this property?
I think it's the size of the property. I wish it was about double in size. I think that would help us, just kind of de-risk a little bit more. But it's not something that keeps me up by any stretch, but it does, it's something that I do think about. Hey, if and when the next downturn happens, what that could look like. Again, we tried to break it in our model. And so by looking at where our break even is and where we need to be, so we've got a good idea on what that would look like and where we need to be. But that's the main thing that I probably don't like about the property, is just it's 56 units. So
yeah. Are you concerned at all about the bridge loan going into a possible softening of the market?
I probably should be more aware of that, but I feel like just where we are in the business plan. And, I don't think, anything's possible, but I don't think we're going to, the interest rates are going to rise by, a full point or whatever over the next 3 or 4 months, which is ideally when we are going to refinance this property. In fact, on our most recent walkthrough, which was just, we're recording this at the end of January. We were out there at the beginning of January, and I had brought my lender out there as well from CBRE. So brought him up. He was based in Atlanta, so it was easy drive for him, but I wanted to go ahead and start to show him instead of just tell him about it and say, hey, look, this is, as he's walking units, we were literally showing him pictures of what it looked like previously. And then he was also seeing it too because we haven't turned every unit. So he was able to see the units that hadn't been turned yet, what it looked like compared to where we were. And so there's a really strong story there. And it just helps, because they're ultimately salespeople. They're going to go sell the deal to Fannie or Freddie and really fight for you. Which I learned that on my most recent deal that we're closing this week. With just the amount of when you have a good lender who's willing to vouch for you and they really understand the story, it truly makes a difference.
Mm-hmm. So I'm coming down to these last 2 questions that I like to ask everybody as we're wrapping up the discussion here on the Pinewood Apartments over there in Chattanooga, Tennessee. And the first question I have for you as we're wrapping it up is, what did you find that was easier than you had expected during this entire process, that maybe before you thought was going to be a little more difficult, but it ended up being fairly easy?
I think for me it was more raising the money. Just having surrounded myself with a strong partnership and a good team. It's still uncertain, these guys had been raising money for a while now, but I personally hadn't been through that process yet. So it turned out to be a lot easier in the sense that it was a good deal. We had proven that we underwrote the deal pretty conservatively, and we did that by just knowing the market, having, the CoStar reports, the comps and all that to kind of back it up. And so that was probably a little bit easier than anticipated.
Mm-hmm. And on the opposite of that, what would you say that you found to be much harder than you had expected moving into this property?
Well, so going through the property manager, the first one, they were, like I said, they really helped us out by evicting the non-paying tenants, because like I said, a lot of them were the problem tenants too, that were kind of attracting the mischief that was taking place. But it was very difficult and very time consuming for me and one of my other partners. We were just so hands-on. And it's not like, a lot of people think multifamily and how passive it is. It can be, and you can have systems in place from an asset management perspective that allow for that, to where, if you have a really good property manager, it's not, they're doing the legwork, and you're more just staying in tune with them, making sure that everything checks out. In this case, we were doing so much work. And I mean, like, we were calling vendors, trying to get quotes. Like, we were just on top of them, and it just felt like such a huge burden for them. And that's why we ultimately pulled the plug and went with a different manager. Mm-hmm. So that part was, up to this point, with my own properties and, some single families, I've always had a really strong property manager. So I've been lucky. I hadn't had to deal with a bad property manager yet. So, that was eye-opening as well. It took a lot of time.
Yeah, I can imagine.
Yeah.
Well, as we're finishing up here, how can the listeners reach out to you if they have further questions about this particular project, or maybe some, they want to continue to follow you more and possibly invest in one of your future deals?
Yeah, no, I appreciate that. So I'm a pretty easy guy to find on Facebook or LinkedIn. It's just Kyle Jones. I'm a part of pretty much all the multifamily groups. I'm in your group, Dan, so you can just search for me there. My direct email is kjones@truepointcap.com. That's kjones@truepointcap.com. I mean, I'll give my phone number out too. I don't care. Like I said, I'm pretty easily accessible and always willing to jump on the phone or have a conversation with somebody.
Well, awesome. Well, thank you so much, Kyle, for being here. Looking forward to continuing to follow you and having you on a future podcast episode as you close more deals.
Absolutely. I really appreciate it, Dan.
All right. Thanks so much, Kyle. Appreciate it.